What are debt restructuring methods? Imagine a country or a company struggling to pay back what they owe. Instead of facing default or bankruptcy, they can work out new plans with their lenders. That's what debt restructuring is all about. It's a way to change the original debt terms so the borrower can manage payments better. This process has been part of financial history for many years, especially during times when countries or companies face big money problems. It helps avoid chaos in the economy and keeps things running smoothly. One common method is loan modification. This means changing the original loan agreement. For example, a government or company might get a lower interest rate or a longer time to pay back. This makes monthly payments smaller and easier to handle. Loan modifications are often used for mortgages or big loans to prevent losing homes or assets. Another way is debt settlement. Here, the borrower and lender agree to settle for less than what is owed. Usually the borrower pays a lump sum that is less than the original debt. This method is often used for unsecured debts like credit card bills or medical expenses. While it can cut down the total debt, it might hurt the borrower's credit score. Refinancing is also popular. It replaces an existing loan with a new one that has better terms. For example, a country might refinance its debt by issuing new bonds at lower interest rates. This can lower monthly payments and improve cash flow. But refinancing can also involve fees and might mean paying more interest over time. Debt for equity swaps are a different approach. Creditors agree to forgive part of the debt in exchange for ownership in the company. This is common when a company has valuable assets but is close to bankruptcy. Creditors then become part owners and can benefit if the company recovers and grows. Governments facing debt crises often negotiate with international lenders. They might get a debt service moratorium, which is a temporary pause on payments, or they might reschedule debt, meaning they extend the repayment period. Sometimes, they get partial debt forgiveness or replace old debt with new debt. During the 1980s, many countries avoided default by renegotiating their debt terms with banks and international lenders. In some cases, companies or governments go through formal bankruptcy procedures. For example, in the United States, Chapter 11 bankruptcy allows a company to reorganize its debts while still operating. The court helps approve a plan that creditors agree to or, if needed, imposes a plan called a cramdown. This process helps keep businesses alive and can lead to a fresh start. Looking at history, debt restructuring has become a vital tool to handle financial crises. It has evolved from simple defaults to more sophisticated negotiations and legal procedures. These methods give both borrowers and lenders options to manage tough financial times without causing total collapse. They are essential in today's interconnected world, helping countries and companies stay afloat during challenging times.